Neil, good to have you here this morning. So let me get your first response here to the numbers. They look pretty good, but the market seemingly unfazed right now.
Yeah, I mean, we have a lot of things to consider. I mean, the one risk, I think, is that, does the fact that the number was better push policymakers further apart from each other in terms of coming up with a phase 4 stimulus deal? You can make a case for some policymakers saying, well, looks like we did enough. The economy is kind of recovering now, and that makes the desperation, it makes them less desperate for a deal. By contrast, if the number was really weak, you could see a scenario where that would kind of push the two sides closer together. So I think, where things stand around the fiscal negotiations is pretty important at the moment. And, I think at the margin, the news that we've seen, not just this morning, but over the last 24 hours, actually indicates that that the two sides may be moving further away from getting to some kind of an agreement on extending support to households and businesses.
Neil, how do we gauge what the organic improvement is in the economy, as there is, for the most part, still a trend of reopening, cases coming off again, states continuing to try and get back to normal? It's not there, but it's generally been in a positive direction. How do we gauge the organic recovery of the economy versus what's being covered up by the Band-Aid of that fiscal help right now? When we pull off the Band-Aid, what's under there right now? What's going to improve without another round of stimulus?
Yeah, I mean, I think it's really difficult to know because the government support to the economy has been so demonstrable, right? I mean, you actually had, the unemployment surge in the second quarter, and delinquency rates actually decline across most loan types. That's highly unusual and sort of speaks to this idea that the government's income support programs are kind of short-circuiting the normal response from the labor market to other areas of the delinquency. So I think it's very difficult. I mean, I think at the margin, things are probably getting better, mainly because, we're seeing some evidence that the coronavirus is coming under control in some parts of the country where it was out of control a month ago. So, to the extent that you see some activity improvement with a lag, that's probably what that's reflecting. But if there's a situation now where the government is no longer supporting households with this income support, that's a problem because, there's no scenario where job openings are going to return to where they were in February. So all these folks that are on unemployment insurance, it's not like they're going to find work immediately. They may look harder, but they won't necessarily be successful because the openings aren't there. And so, the risk, of course, is that it ends up becoming more of a hit to demand than having anything to do with labor supply constraints or anything like that. And so I think you have to be a little bit nervous about what this means for the outlook for consumer spending. Now, there are certainly industries in the economy that are having relatively rapid recoveries. Things obviously like housing. We know that inventories are likely to restock. All right, there's not much more inventories can go down, so all inventories need to do is stop falling as quickly as they have been, and that's going to be good for GDP growth. But there are still broad swaths of consumption that are well below normal and will likely fall even more if there's no government help on the way.
So, Neil, for the amount of jobs that are open right now, do we know, can we basically do a calculation saying, hey, here's the amount of jobs that are open, here's the amount of jobless, and then come to some number basically to understand what amount needs to be pumped into the economy? Because the point I'm driving at is, there's this is kind of a binary approach, which is we need help or we don't need help. It seems like we definitely need some more help. But how much? And from an economist or even from an investor's perspective, how will we know when we get that report if it's sufficient? If this weekend or today a headline drops that this is coming to the economy, how will we know if it's enough, if it's an accelerant, a depressant, a market neutral impact? How will we gauge that?
Well, I mean, I think one area where it's pretty obvious where you need a lot of support is state and local government. And, I think you can make an argument that state and local governments, just to plug their revenue shortfalls, you need at least $750 billion. And so, I mean, look at the number today, right, Ali? A lot of people were expecting the state and local government jobs to go up about 800,000 or so over the month. The fact that they didn't sort of speaks to this idea that there's still a lot of weakness in state and local governments, right? Because we did pull a lot of job loss forward because of the pandemic. So the fact that we're not really seeing much recovery right now suggests that there's still a lot of weakness there, and that's highly unusual, right? I mean, you typically see state and local governments act as sort of a stabilizer, a shock absorber of sorts. They don't tend to bleed jobs this rapidly after a recessionary shock, but it's happened quite quickly, right? They have been shedding jobs just as the pandemic started. So I think you can make a case for state and local governments, and I think you can make a case for households because we're still well below where we were in February. We've recouped about 45% of the job loss from March and April. And it's hard to call any of those jobs being gained. I mean, most of the increase has been, in the last 3 months or so, most of the job growth has basically been in leisure and hospitality and retail. So, I think you can make a case for the fact that a lot of this is just, government support programs and the like that are driving this improvement.
Where does the virus and the curves fit into the economic analysis right now? Because as we're talking about at the top of the show here, we got this continued or second wave into the other states that flared up over the past month. But we saw just a plateauing of some of the high frequency data, never a big rolling over, at least the ones that we've been watching. And now we see the curves for the cases demonstrably going lower again. If we're coming off another peak and going down, is it possible that our improvement for the unemployment rate will also increase in momentum? How does that fit into the analysis right now?
Yeah, I think so. What we've seen is that there's some relationship between the spread of the virus and the propensity for businesses to open or shut. And so, to the extent that the drop in cases is real, I mean, remember there is some evidence that some of the decline in cases is also a function of reduced testing. So I don't know if it's how real the drop is. I mean, it's good, but we have to sort of see how this goes on over the next few weeks. But to the extent that it's real, it should provide some lift to business, sort of reopenings over the next number of weeks, and in turn that should help buoy employment. So, the Fed has said this in their last statement, is that the course of the economy depends very much on the course of the virus. And so, to the extent that the coronavirus is less prevalent in the country, that should be good news for businesses to reopen, and that should be good news for employment. So, certainly I think we've seen some evidence of that in the last week or so, given the drop in jobless claims and things like that. So, I think that would be a good sign.
Neil, just real quickly before we go, because we got to take the opening bell here in about 20 seconds. We're also looking at a chart here that shows that the transportation jobs continue to show some pretty big losses. But I want to get your thought just on the rate of the unemployment. We dropped a full percentage point from the last reading. Is that sustainable? Could we shave off a percentage point every month?
I mean, there's so much inertia and so much flow in the jobs market. It's hard to know what's possible. I mean, in all honesty. But I think the thing that worries me is as we go into the fall, there's some reason to expect the labor force participation rate won't go up. I mean, if people are having issues, securing childcare for their kids, given what's going on with the schools, and so you can easily see a situation where parts of the economy are continuing to heal, and you're seeing employment growth, and the unemployment rate is declining more rapidly because the participation rate's not falling.